Welcome back in, everybody. So I've had a few requests here to do a new strategy with you guys live. Now, I'm not an expert in options, but I do use options to create additional revenue or additional yield in my portfolio, lower the beta, and take some profits. In this video specifically, I want to go over a covered call strategy on dividend stocks specifically because I believe this is going to be the best way to create some additional yield in your portfolio. And I also believe it's one of the best opportunities in 2025. Now, the Trump rally has absolutely disappeared. We are back and below. So volatility in 2025 is absolutely going to be here. As most of you know, I've projected that the end of 2025 could bring a recession. And I still believe that is absolutely on the table. But specifically in this video, I want to stay on track. Once again, this is not financial advice, and an option is basically just a contract to perform a future transaction. Options can be very lucrative, but it also can be very dangerous. In this video, we're going to use a very safe strategy to create extra income or extra yield into your portfolio. So let's get into it. Now, before we get into today's video, the thing I do want to point out here is that 97% of stocks were trading above their 200-day moving average, and we were staying basically between 80 to 90% of stocks trading above their 200-day moving average. Now we're down below to 49%. You can see this big move to the downside. 49% of stocks are now trading above their 200-day moving average, which means that over 50% of stocks are essentially approaching bear territory. But the price is actually not showing us on the stock market. Yes, we're down a few percentage points from recent highs because about 4 names are carrying about nearly 40% of this market. So the true story of this market is actually we're heading into bear territory, believe it or not. So I wanted to point that out to everybody on top of the fact that we are forming a head and shoulders pattern on the S&P 500. So for you technical geeks, I'm sure you're following this. And for most investors, they probably don't care, but I tend to think head and shoulder patterns are some of the best patterns to follow and respect. I'm not saying you need to sell everything, but I'm saying you need to pay a little attention here. So for this strategy, I want to focus on the best of the best dividend payers, and that's going to be dividend aristocrats. Now, once again, guys, dividends are not a magic item. They come from company profits, and they actually come from the stock price and move into your brokerage account, meaning that if you have a $27 stock and the stock pays 50 cents of dividends, you now have a $26.50 stock when the dividend is paid, and you receive 50 cents in a dividend payment. Now, for this strategy, the most efficient way to take advantage of this is to be in a tax advantage account. The reason being is dividends are a double taxation. They tax the corporation that you're invested in when they pay out the distribution, and then they tax your account when you receive the dividend. What I want to highlight here is some of the best dividend payers out there, the dividend aristocrats. So dividend aristocrats are dividend stocks that have paid their dividend and raised their dividend for the last 25 years. And out of all the stocks in the stock market, there is not that many dividend aristocrats. Now, as the stock market has progressed, we've actually seen a tremendous amount of buybacks rather than dividend payments, and buybacks tend to be the most efficient way to reward shareholders. But for this strategy, I really want to focus on a few different things here. Now, I've done some analysis on some of these names, everything from Ben Franklin, which I've looked at. Obviously, you guys know Realty Income. I've done multiple analysis on T. Rowe Price, Stanley Black & Decker, Archer Daniels Midland, and SJM are definitely some names I brought up. Oh, and down here at the bottom, Hormel Foods. So the first thing I would think about is if you're very bullish on the economy going forward and you're specifically bullish on the housing market, then you could definitely be looking at something like a Stanley Black & Decker, who pays a 4% dividend and has kind of been an underperformer over the last few years. If you're more on the defensive side, well, consumer staples have definitely been presenting an opportunity in this recent sell-off. Consumer staples have been dealing with high inflation, so if you're more concerned about the economy, consumer staples might be the better play. If you think that we're going to be higher inflation, but the economy is going to be strong, then something like energy or Chevron would be a good possible play here as well. Now, for me personally, to get the compounding effect, you want companies that are buying back stock, you want companies that are growing and paying a dividend, and you want companies where the earnings are very predictable and safe. You don't want a tremendous amount of price action. You want something that's slow and steady that maybe moves a few percentage points every couple months. And this is the way to capitalize on volatility on good quality companies. I don't recommend doing this with any sort of high flyers. The reason being is if you buy a contract and you're writing covered calls against it and collecting, 50 cents, a dollar, and then all of a sudden that stock shoots up 20, 30, 40%, you're now losing hundreds of dollars to close out that option contract. So specifically, this is why I like the low beta stocks. And if the contract gets called on me, it's okay because I could always buy back in on additional dips because these stocks tend not to move too much. So for this purpose, I actually want to use SJM Smuckers as the example here for multiple reasons. Number one, I think that consumer staples are getting pretty interesting at these levels. And number two is I've actually done a pretty good analysis on this stock, and I think I'm fairly accurate here. And this is a great example. If we go over the last 5 years, the stock was trading around $104 a share, got as high as about $160 a share, and is now back below $104 a share. So over the last 5 years, you have essentially made no return on this besides the dividend. And this is why this strategy works perfect for a company like Smuckers. You know, this is a company that I think could get into the 90s and would be interesting at that point. And I think from there, it could get to about 120, 130. So not a tremendous amount of movement, very predictable, and pays a nice yield of over 4%, which is pretty close to where interest rates are currently. So as you guys see here, I do think there could be an opportunity to scoop some shares in the high 80s to low 90s. So I have an ideal price target sitting pretty darn close to $91 a share, and it looks like this could definitely happen. We could see a pretty significant sell-off for people that have been holding the stock since $104, watched it go up to $160, and now see their investment below $100 a share. Now, this is not going to get you rich, but this is a way to put some stability into your portfolio. Something boring, something safe, something where you can sleep at night and know that you're going to get a nice return of 4.5% dividend yield. And if we're able to write some calls here, which we're going to go over right now. Now, for me personally, if I like a position and I don't want to really sell it, I'm just looking to collect premium, but I'm okay if it's sold, I'll go out roughly a month. You want to pay attention to earnings. You want to pay attention to anything that can really move the stock as well. So if you want to hold on to the position, I recommend not going any more than a month out. And for the most part, these types of stocks don't move a lot, but you just never know. So writing a monthly contract to me is probably the most safe and lucrative way to really capitalize on this option. Now, let's say I recently bought some shares around $100 when the close just happened on Friday. We can see here that they do pay dividends right before earnings. So we have a dividend payment of $1.08. So for me specifically, what I personally would look to do is actually write the call around their dividend. This gives us an advantage. So we know that when this dividend is paid out, the stock is going to be roughly $1 cheaper than it was. Now we can get a little bit more aggressive on our option contract and collect a little bit more premium. So we see here that they are reporting earnings on February 25th. So I want to write an option contract right around that early February mark because I know they're going to end up paying a dividend. The stock's going to go down roughly $1 wherever it's trading by that time frame. So perfectly enough, we have February 21st option contracts. We saw earlier that we could be looking between 7 to 10 business days before they report earnings that they pay that dividend. Now, maybe I'm willing to sell the stock around $105 by that time frame. When we really think about it, that is only a few short weeks away, and that would be a 5% move in this stock, which is a pretty substantial move in a company like Smuckers. Now, the key to this is you do have to own 100 shares, which means if I bought 100 shares of Smuckers, that's a $10,000 investment at $100 a share. Now the contract's allowing me to sell a call between 150 to probably 165. So what I would do is I would actually try to bump it up to around 160, sell the contract for 160, hit confirm and send on those 100 shares that I own. Now, of course, I don't own any shares, so it's not allowing me to do this, but you guys can see here that I would collect $159. So let's jot this down really quick. I buy SJM for $100 a share. Let's call it on January 9th, 2025. So I own the underlying asset of Smuckers for $100 a share on January 9th, 2025. And I'm going to write a contract to perform a future transaction on February 21st, 2025. And I'm willing to sell the stock for $105, which for easy math would be a 5% gain in a little over a month. Now, if we annualize that out, that'd be pretty darn close to 55% annually. So if anybody got 55% annually on a very low beta name like Smuckers, I'm sure you would be thrilled and take that every day of the week. But in here, we made a transaction of a covered call and we collected $1.65, let's say, for willing to sell that contract out. So we collect $1.65 per share to collect this contract, which comes out to $165. And the reason why we collect this premium is because we were in agreement to sell this stock for $105 on February 21st, 2025. But if the stock is trading below 105, we keep the premium. We collect a dividend of $1.08, which is another. So we keep that premium of $165, and we collected an additional $1.08 per share, so we take that $165 of premium that we collected, and because we're holding the contract through the dividend date, we actually get that $1.08 that's going to be paid in the middle of February. We add that up, that's $273. So we take that $273 and we divide it by our original investment, which is 100 shares of Smuckers that we bought at $100, which is $10,000. Now this adds 2.73% we've collected in premium and dividends, not including stock appreciation. So I will just put 2.7% on here. And do you guys remember what I said when a dividend is paid? It comes out of the stock price. So that means if Smuckers is trading at 106 on this date and it pays the dividend, we're actually below 105, which is an ideal situation. Now, if that plays out perfectly, we've increased the equity position by 5% because Smuckers is now trading at 105. And we also collected an additional 2.7% in cash flow from the premium we wrote and the dividend we collected, which then brings it down to a 7.7% rate of return in just over a month. With a position that I wouldn't mind owning. I know it's boring, but as you guys can see here, sometimes boring can be profitable. So as always, guys, hopefully you enjoyed this quick tutorial on how to write covered calls against great dividend payers, and we will see you all in the next one.